Hi, I'm Jerry Muralatis, Senior Wealth Advisor at ProSolution Wealth Advisory, and together with Stuart Wames we're just going to take you through some of our thoughts on investing in property.
These presentations are best viewed in full screen mode, and you can activate that just by clicking in the bottom right hand side of the screen as circled here in red, and on the bottom left hand side you can use the controls to play, pause and fast forward the presentation.
Much has been said and written about property investment, and Stuart's responsible for a fair bit of that. And it's often been compared to investing in shares, and that battle will rage as to which is the better. I guess the starting point for this discussion is, what is the attraction of property? Essentially a couple of key things. One is control. It's an asset that a lot of investors find very appealing because they can change it, they can improve it, they have a lot of control over it compared to shares, and also the fact that it's a very tangible asset. The other one is leverage. You can borrow to buy a significant proportion of a property, which those of you who've borrowed either through margin lending or other share borrowing facilities know it's a lot harder to do with shares. I think one of the great features of property investment, particularly the way we approach it, is that you have capital growth when you need it. That is in the accumulation phase of your wealth creation, and then income when you need it, which is later in the retirement phase.
Okay, let's talk about some common errors that property investors make and that we certainly see regularly in our business meeting new clients. I actually think that more property investors get it wrong than they do right. And that they're not actually enjoying the returns that good quality investment grade property should provide. So what are some of the common errors we see? Well, probably by far the most common is the wrong property. So people incorrectly mistake that any property is good property, rather than believing or understanding that really, it's the top sort of 5 or 3% of property in Australia that actually is what we would regard as investment grade, that's going to provide good, strong returns. And it's that sort of property that we need to be focusing on and investing in. No strategy, so I guess that's just going out and buying a property when we sort of feel comfortable doing so. Rather than having a strategic overview of how many properties, where they're going to be located and what type. And not reviewing performance probably goes hand in hand with the first mistake, really buying property, crossing our fingers and hoping for the best, and not sitting down regularly, probably annually, and looking at what is the capital growth return I've received and what's the rental return and is this adequate. They're the probably top 3 mistakes.
So in choosing quality investment properties, we believe the formula is quite simple. The 3 key things you need to look for are scarcity, land value, and proven performance, rather than looking at the next best performing suburb. So let's address these briefly individually. So scarcity is the old principle of demand and supply, and that's never going to change. A great supply of whatever asset, commodity, etc. will always result in a lower demand or reflect in the price. Whereas a great scarcity, low availability of supply will reflect in greater demand and greater price. So the factors that affect this are location. The saying again that they stopped making land years ago. Something with a greater land value component will have a greater scarcity. Accommodation style can also affect this. So, for example, Art Deco 20s and 30s style unit developments will have fewer on the block than, say, 70s, 80s type development. And this leads us into land value.
Okay, let's look at land value component. I guess we're all familiar with the idea that land appreciates and buildings depreciate in value over time. So it stands to reason that the higher proportion of land value as a proportion of total property value we have, the better chance we have of enjoying strong capital growth. So this graph looks at a $500,000 property where the land value component is only 20%. And this would not be uncommon with new build apartments or off the plan purchases and so forth. In fact, you'd be lucky to get sort of 20% land value. So in this situation, the building value is $400,000 and the land value is $100,000. So if we wanted this property to double in value, say over the next 8 to 10 years, what needs to happen for that to occur? Well, building value will probably depreciate, but in this chart I've just assumed that it holds steady. That's probably not true, but let's assume that. So therefore we need this land value component to really increase by about 600% or 6 times for the overall property value to double over that period. That's probably a really unrealistic expectation. You want to be buying some very scarce land locations for that to happen. So let's look at the next slide that has a greater proportion of land value. Okay, in this slide we've got the same $500,000 property, but this time the land value component is 60% or $300,000. And for this property to double in value from $500,000 to $1 million, what needs to happen is the land value needs to increase by $300,000 to $800,000. So that's 2.7 times what it's worth today. A far more realistic number than the 600% in the previous slide. What most people don't realise is that whilst houses have their own parcel of land, apartments also have an attributable land value. So apartments often sit on very valuable land, and if we've got 10 apartments on this very valuable land, you can potentially apportion the land up into sort of 10 parcels, and that's its land value component. So when investing, we would expect investment grade property to generally have a land value component of 50 to 60% for apartments and even higher for houses. And it's important to focus on this land value component because the absence of a strong land value component, you're going to struggle to get strong capital growth.
Anyone who's invested in shares and managed funds knows that the prospectuses and PDSs typically say past performance shouldn't be taken as an indicator of future performance. In fact, with quality residential property investments, the reverse is true. Due to the nature of things like the scarcity of these properties, a lot of them have been around for 50, 100 years and becoming scarcer. So, in fact, their past performance is the best indicator of their likely future performance. I mentioned earlier, we don't look for the next best performing suburb, growth corridors, etc. It's proven past performance. Now we're going to hear from Monique Sasson-Wakelin. Monique's Managing Director of Wakelin Property Advisory and what we'd consider an expert in quality residential property investment.
Thanks very much for your time, Monique. We often get asked, is it a good time to invest in property? So what advice would you have for someone that's wondering if it's a good time to invest in property, or even if they start asking questions about picking or investing the next growth suburb, the suburb that's about to take off?
Well, Stuart, it's a question I'm asked very, very often, and my answer is pretty much standard no matter when I'm asked the question. The real issue is not to try and chase the market and get some kind of precise timing mechanism going, because the reality of the property market is that you're investing for the long term, and what I mean by that is 5 years and more. And if you try and time the market, 99 times out of 100 you're going to get it wrong. So the best time to invest is when you've got the available funds and you can afford to do so within a reasonable price category, and for Melbourne, Sydney, the major capital cities, it's somewhere in the range of 400,000 and above. And to buy the best quality location and the best quality property that you can afford, and don't get too hung up on timing.
Fantastic, Monique. We always recommend that clients go out and get advice in regards to which properties they purchase, so get advice from an investment property advisor. In terms of selecting which advisor to work with, what advice do you have in regards to how to select that right advisor?
Well, independence is absolutely critical when it comes to selecting any kind of advisor, whether it's property or finance or shares, it doesn't matter what it is. And the test of independence is very simply this. Ask your advisor how they are remunerated. and be very, very suspicious and wary of any advisor who says to you that their advice is free, because nothing that is worthwhile in this life, as we all know, comes free. So that's the first litmus test of getting good independent advice. You can absolutely bet your last dollar and the shirt on your back that the person who is doing the paying is the person who is being looked after. So ask them how they are qualified, whether they do any ongoing professional education, how they're paid, and then you should be in a much better position to assess, in fact, whether the advice you're getting is truly independent or not. You also want a property advisor who has unrestricted access to the property market, so they're not tied up with developers or financiers or estate agents, that they can basically go out and buy you a property anywhere in the open marketplace without any kind of restriction whatsoever.
When some clients look at the fees that property investment advisors charge, they often think, well, you know, I could probably do all this work myself and avoid paying the fee. In your opinion, what do you think clients are getting when they do engage an investment property advisor?
Well, look, the first thing about doing it yourself is that anybody can do it themselves. What it comes down to is how well they do it, and whether you in fact know whether you've been overcharged, shortchanged, properly advised or not properly advised. And you know, the old poke is very simple. You don't know what you don't know until you know. And so when it comes to getting property advice, if the advisor is good at what they do, they will have a long track record and be able to demonstrate that track record of success to you. What effectively a good property advisor will do is that they will advise you on how best to deploy your available funds in the property market. And what that means is where to buy, so location, what kind of property to buy, and whether in fact your stated financial range should be spent in one direction or one location only, or whether it's best to split that up into two different locations. Having established that, they will then go out and execute that strategy for you. And they will use their experience and professional expertise to pick the eyes out of the market for you and make absolutely sure that you're not buying a lemon of a location or a lemon of a property. They will also assess the property's track record of capital growth for you. They will assess its forward potential, whether it's got potential to add value, whether it's going to grow at 5% likely per annum, 4%, 3%, 10%, etc. And they should know what that area has done in the way of both rental performance and capital growth history over the last 5 to 10 years. So you're getting a whole suite of different kinds of expertise. So once that's been done, then it's the property advisor's role is to negotiate the most optimum purchase price for you, the investor. And the key here is to stop you, A, getting emotional about your purchase, and B, to save you money on the purchase price as much as the market conditions will allow. So you can see it's multifaceted, it's very complex, and it's not as straightforward as going and throwing a dart at the Melways or having a look at the local newspapers and crossing your fingers and hoping for the best.
That makes perfect sense, Monique. Thanks very much for your time.
It's a great pleasure.
Okay, now that we've discussed the fundamentals of property investing, let's talk about our approach. And I think it's relatively simple to be a successful property investor. You just need to know what to do and when to do it. So we start off by developing a long-term strategy. There we want to design exactly what our property portfolio is going to look like. Is it 2 apartments and 1 house? Is it one property owned by a trust, one in personal names, one in a super fund? So developing a strategy that encompasses those sorts of things. The second rule we think we need to abide by is get advice before we buy the property, before we invest. We're often spending a lot of money, so it makes sense to get an expert opinion. We would say outsource that to a buyer's agent or investment property advisor. But if you choose to do the work yourself, at least get a second opinion. And thirdly, review the performance. We see people fall into the trap of reviewing the cash flow performance. So they look back and say, well, this property's not costing me any money, the rent's going up, it must be working. But really the critical success factor with property is capital growth. and that's where your attention should be. So looking at how the property's value has changed over time in comparison to the median of that